But let's first put the focus on Ujjivan Financial Services. It's been a stable quarter, so to speak, for Ujjivan Financial Services. I mean, at the bottom line, if you take a look at the bottom line number, it's a net loss of around 12 crores versus a loss of 73 crores. So that has contracted. The net interest income has come in at 164 crores. We'll just quickly take you through the numbers first. The net interest income, and this is the consolidated print, that's coming at around 164.6 crores. It's an increase of 19% over the last year, and it's a decrease of 12.5% over Q2 FY17. So it's an increase of 19% over the last quarter, pardon me. The cost to income ratio has reduced, so that's a good thing. The net interest margin is coming at 10.55% in Q2, which compares with 9.23% in the last quarter. But compared to the last year, it has come off a bit. If you take a look at the small finance bank, and that's also the more interesting bit of the operations, NII is at 195 crores. It's a 12.4% increase on a sequential basis. As I said, I mean, there are no year-on-year numbers for this because it's been 6 months of banking operations. The NIM is at 10.2%. It's expanded from 8.9% in the last quarter. And the bank has said, of course, that the scheduled bank status has boosted the deposit business as well. Deposits constitute 22% of advances in Q2 versus 6.6% in Q1. But let's get in the management to get more details on these numbers. Sudha Suresh, MD and CEO of Ujjivan Financial Services, joins in now. Good to have you on the show, ma'am. Thank you for joining in. It's been a stable quarter for you. The costs seem to be receding. How are small finance banking operations progressing?
Good morning, Pranay, and I think it has been a good quarter overall in terms of a number of parameters. Firstly, we have recorded robust disbursements of about 1,954 crores, which is an increase of 15% over the last quarter. And overall, we have also seen collection efficiency of the entire new portfolio, which we have created between January 2017 to September 2017, having an impressive track record of a collection efficiency of 99.7%. Also, we have taken key impact of the credit costs arising because of the demonetization, both in the Q1 and Q2. So there has been also a reduction in terms of the credit costs. There has also been a turnaround in terms of collection in overdues. We have also seen the PAR come down to almost 6.7%. We have seen both GNPA and NNPA on a healthy decline, and all these augurs well for us. And coupled with that, enablers are the scheduled bank status, which again helped us to raise low-cost funding. We were able to tap the CD market. We were able to raise about 615 crores through CDs in September itself. And we look at the cost of funding coming down further in the next 2 quarters. Overall, I think we have also had lower operating costs, or a flat operating cost, I would say, which has helped us in our cost-to-income ratio in Q2. So that has come down to 68% compared to 72% plus earlier. And we will see the cost of income, in spite of the fact that the SFB operations continue to expand in terms of the number of branches which are going to get converted as bank branches. We have 100 plus branches now, and we look at 160 branches for this financial year. In spite of that, we do see the business getting boosted, and overall in the third and the fourth quarter, the numbers would augur well for us to bring down our cost to income ratio further.
Right, ma'am, that's the thing I wanted to ask you about, because, we've seen, without taking any names, other peer category, competitors, the costs are actually going up as far as the operational costs are concerned, as you expand your liabilities franchise and as the small finance banking operations go up. This is one thing that seems to be a little interesting. How are you managing to contain costs? And, what's the lever? I mean, for the next half year, could we expect some escalation in costs on back of the liability franchise expanding, on back of the small finance banking operations expanding? Or is the cost to income ratio likely to remain subdued and, in fact, if anything, go lower?
So we do expect the cost to income ratio, in spite of the fact that we are going to expand on branches. We have technology which is well set. We had taken a reasonable amount of fixed costs already in our last fiscal year, and we will be able to support and manage costs in such a manner that overall our cost to income ratio need not deviate much from the present levels. In fact, we do expect the cost to income ratio anywhere between 65 to 68%, hopefully by the close of this fiscal year.
Right. Ma'am, let's also speak about the cost of funds. Now, you said you've managed to raise from certificates of deposits as well. Would like to know an overall profile of your, the borrowing profile as it stands right now. Another thing is that, the yields have gone up from 6.18% in December last year. Now the 10-year yield is at around 6.8 or 6.9. Are you tapping the bond market as well? Is there some kind of pain that you're sensing from that quarter? Because the last time we spoke to you, you had plans to approach the bond market as well.
So I think right now what we are looking at is a good mix of short term and long term, and liquidity seems to be very comfortable for us. I think there is enough scope in terms of not only liquidity but also being able to raise it at very competitive rates, courtesy a well balanced and diversified mix of loans coming from long term loans coming from SIDBI, NABARD and Mudra likes. We are also looking at the short term funding which comes from the money market as well as CDs and as well as the retail deposit franchise that we are raising. So at this juncture we are not looking at raising bonds, but hopefully in the near future we will look at that also. But overall the position of liquidity is very comfortable for us to augur our business.
Gross and net NPAs both have gone down. So, in the run-up of expansion of your small finance banking operations, how do you see asset quality panning out? Are we to go with the safe assumption that your GNPAs are likely to remain below 5%, or, in the run-up to adherence to standard days past due, could there be some spike that we could see in possibly provisioning or asset quality recognition?
In fact, on the asset quality, we would like to reiterate that the asset portfolio which we have created between January to September 17 continues to show an impressive track record of 99.7%. Having said that, and also since we have taken the major impact of credit costs arising due to demon in our first 2 quarters, we can look at only credit costs in the normal course of business, which can implement, which can which we can see in quarter 3 and quarter 4. And overall, we do expect that our GNPAs will not be more than around 4% of the portfolio. And we do see that the asset quality will maintain itself fairly well, because we have taken probably the impact of the asset portfolio which has been hit due to demon already in terms of our first 2 quarters.
Right. If you can speak to us a little more in detail about how the repayments are looking like for the microfinance business. As you said, demonetization of course had impacted. Is it, completely back on track, and how are disbursements seen in the microfinance portfolio? Secondly, if we take a look at your state-wise portfolio mix, bulk of it comes from Tamil Nadu, Karnataka, West Bengal and Maharashtra. Together, these account for almost 50 to 55% of your book. So my question is that Tamil Nadu, we've seen some risks. We've seen some risks in Maharashtra as far as farm loan waivers go. So is there some kind of problem that you're facing in terms of, recoveries and repayments, or has everything come back on track?
So since Ujjivan is a well geographically diversified portfolio, we have seen business back to normalcy in many states. However, having said that, the states that you had mentioned, typically Maharashtra, and we have seen West Bengal, of course, has very good portfolio. We have no problems there. But Maharashtra to some extent, Karnataka and Tamil Nadu, of course, it again at a very low percentage. In fact, even less than 2% is what we see the portfolio at risk in Tamil Nadu. So overall, I think the pockets, some pockets in Maharashtra and some pockets in Karnataka and in UP. These are something where we are looking at the portfolio at risk, and we have consistently seen an improvement there over the last 6 months. So we do hope an excellent collection team that we have put forward, we will see better traction in the next 2 quarters. We have seen excellent traction in the last 2 quarters also, which has helped us considerably to reduce our portfolio at risk. And overall, we see that the impact of all this will be more or less, apart from what we have taken in our books, it is behind us now, and we look at a robust disbursement growth again coming quarter on quarter. We disbursed about 1954 crores this quarter, and we look at our disbursement increasing in both the next quarters. Overall, the situation, both in terms of tapering of credit costs, in terms of increase in business, in terms of reduction in cost of funds, and being able to maintain a reasonably flat operating costs, I think we are a pretty good position when we look at the next 2 quarters.
Right, ma'am, and very quickly before we let you go, your gross loan book I think now stands at 669 crores. What's the kind of increment in your loan growth that you're seeing, and tell us about whether you're chasing higher yielding the higher yielding book, because my question is from the standpoint of the net interest margin that has gone up to 10.2% as against 8.9%. Is this sustainable? I mean, double-digit net interest margins, because it will obviously depend on your CASA, which is your funding, which is obviously, if I'm assuming that you're targeting a low cost funding and you're targeting high yield lending.
Right. So talking on our gross loan book, firstly, we had given an indication of about 18 to 20% growth from the last fiscal year. I think we will be in a position to look at that 18 to 20% growth in this fiscal year. Having said that, the reduction in cost of funds, which is coming through alternate source of funding, and also the build-up of our deposit base, even though CASA may grow at a slower rate, we do have a good traction in terms of the fixed deposits and other term deposit products that we are seeing. And overall, we are also seeing institutional deposits shaping up pretty well in terms of the lower cost of funding. We should be able to garner both funding at competitive rates and bring down the cost of funds, and at the same time we can look at a double digit in terms of our net interest margins, and we will see how these 2 quarters pan up, because with increase in business and increase in interest income, we should be sort of able to maintain that.
Fair point, ma'am. We're going to leave it at that, but thank you so much for joining in, giving us a detailed breakdown of how the quarter has gone by, how your loan growth looks like, and more importantly, how the liability franchise and the expansion of the Small Finance Bank operations are progressing. But let's move on now and speak about market valuations as well as how earnings season have been up until now. What are the sectors to favor, especially at a time when the Nifty, the Bank Nifty and the Sensex and even the mid-cap and the small-cap universe are seeing life high levels? We've got Dhananjay Sinha. He's economist and